Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, and regulatory landscapes and capital markets. This segment is brought to you by Charles Schwab. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site is Mark Marex, Senior Director of Index Research and Development at Nasdaq Global Indexes, as well as Simeon Hyman, Global Investment Strategist at ProShares. We're here to discuss Nasdaq-100 outlook for the second half of 2025 and ETF strategies that incorporate options to hedge against volatility. It's great to have the both of you with us. Welcome back to Trade Talks. And Mark, before we get into outlook, the first half of 2025 certainly was perhaps something we didn't have on our bingo cards going into the year.
No, I don't. I think only a few people had it. I've read about those few people, and they have special talents that I definitely don't have. But, you know, it was a roller coaster. I think that's the best word, right? All-time highs in Feb, true bear market, bottomed in April, right? April 8th. Furious rally after that, one of the strongest and fastest rallies we've ever seen off of a bear market for the index. And then overall, right, we ended up about 8% up year to date for the first half after literally the strongest quarter that we've seen in years in 2Q, when we were up about 18% on the index. So a lot of macroeconomic noise in the first half is how I would describe it, kind of, you know, looming over market sentiment. But underneath, right, at the micro level, really strong fundamental results from a lot of the big names in the index, a lot of the smaller names too. And that's, I think, what investors really started to focus on as we got towards the end of the quarter.
Yeah, I mean, Simeon, corporate earnings were quite good for the first half of the year.
Earnings are strong, and yeah, I'm still a fundamental guy. I'm not one of the guys with the magic crystal ball, but you take a look at, as an example, return on equity for the Nasdaq 100. It's almost double what it was 20 years ago, and we're at the same 29-30 PE. So that says a lot. People get nervous about those valuations, but the fundamentals are really strong.
Yeah, it's interesting that you call that out, because I think you get so fixated on a specific number. You know, what is the PE relative to other companies similar in the index, or if you're looking at, relative indexes and so forth, where sometimes you have to pull the layers back from the onion and extrapolate what's happening.
There is such a thing as earnings quality.
Right.
And if the return on equity is that high, that means that you are getting more dollars of earnings per dollar invested in that company, and that does a lot to support valuations.
Yeah, it certainly does. And Mark, of course, the question going forward is, do we expect more volatility through the back half of the year? We're coming into earnings season starting in earnest next week. June is relatively quiet. It's really focused on macro and what's coming out of the administration. Now we're going to start to get some corporate commentary.
Yeah, for sure. And I mean, to be fair, with all this noise that's taken place, estimates have come down a little bit versus beginning of the year, like 3 to 4% in terms of full year earnings this year and next for the Nasdaq 100. So there has been some impact there. But again, you look at the results in 2Q, you look at a lot of the guidance that was coming out from names like NVIDIA that are just reporting really continuation of record growth in some of that underlying AI demand. Names like Microsoft seeing 5 or 10x growth year over year in overall demand for their compute related to AI. That's how you end up with 22% year over year earnings growth for the index. Yeah. That was substantially higher than already, fairly optimistic consensus estimates of around 17%. I think the S&P 500 delivered around 13% growth. So most of that actually did come from the Nasdaq 100, which is about half of the S&P at this point, and speaks to, again, the fact that, whatever you end up throwing at this index over the last few years, whether it's record high inflation, whether it's geopolitics, whether it's high interest rates, it still finds a way. A lot of the big names in the index, a lot of the smaller names too, still find a way to keep that fundamental growth going. And that's why, you really haven't seen a big spike in valuations recently. Despite the good performance, when you've got 20-25% earnings growth annualized, you're not getting that much more expensive because of that fundamental growth.
Yeah, it's interesting, Simeon, because the semiconductors, if you look at them in the aggregate relative to the index, nearly doubled the Nasdaq 100's performance, which lends to the fundamentals that you were talking about before and the demand for semis.
And it's also the opposite of what was called in the late 90s. For those of us who are old enough to remember this, there was a famous book called The Innovator's Dilemma. And back then, the notion of the Innovator's Dilemma was that innovation would depose the incumbent companies. But this time around, that's not necessarily true. There are startups that are having a good run, but many of the companies that are taking such tremendous advantage of AI are folks that have been with us for 20, 30, or 40, or 50 years. And that's different too from what we saw 30 years ago with the first round of the internet revolution.
I wonder if these types of companies don't necessarily have the headline risk or exposure to tariffs due to the nature of their business, if that was helped it weather the storm a little bit better in the first half.
We don't know.
Right.
Certainly there's an element that you almost think there should be a little bit of caution, because I think sometimes people are getting a little too euphoric about tariffs coming in a lot better than they looked like on Liberation Day, but they're still likely to end up north of the average overall, which was only about 3% prior to the administration coming in. But still, there's upside here. The agreement with Canada to bring down those digital taxes that were in place. So there may be some negotiations that may benefit some of the technology firms around the world coming out of these tariff negotiations.
Yeah, so the question is, Simeon, when you think about ETF strategies and hedging against volatility, because we just don't know what that picture is going to look like, how does one think about that as it relates to their portfolio overall?
I think there's two pieces of that we've been focused on at ProShares, and both of them leverage the new opportunity, new meaning in the last several years, of daily index options that have exploded in volume but also in resilience in terms of the market. And one of those is our strategy IQQQ, which is our Nasdaq-100 high income ETF, and that uses daily options to execute a covered call strategy. And there, it's the opportunity to get the high income and the opportunity to participate in Nasdaq-100 upside and get a lot of the money that was left behind by traditional monthly covered call strategies. This was so important coming out in April because you had this drawdown from Liberation Day just for about a week, and then this massive upturn. IQQQ allowed you to participate in that upturn to the tune of almost double the returns of traditional monthly strategies. So that's the notion of kind of not being an accidental market timer, but using these options to get income and participation. But then to your point, who did not participate in that rebound? People who sold out after Liberation Day. And that's where our second innovation, and its ticker QB, that's our Nasdaq-100 Dynamic Buffer ETF, which we just launched, uses those daily options to do, for the first time, a daily buffer strategy. And that allows you to have a daily buffer. It dynamically adjusts with volatility, so more protection when you need it. And very importantly, no surprises. Traditional buffer strategies have a defined period. You have to be in them for exactly a year or exactly a quarter, or they don't do exactly what you think they'll do. Now with QB, you have that on a daily basis. You can enter it any day, and you know what the buffer strategy is and how it will express itself.
Yeah, and Mark, that's what's so interesting with these ETF wrappers is that these are strategies for the average investor wouldn't be able to replicate. One, efficiency is one of the reasons why, taxes of course, and then just it's complex. So, underneath the ETF wrapper, we're seeing that trend where more investors, more advisors are looking towards option strategies.
Right, right. I mean, if you're a retail investor or you're an advisor, right, you don't want to be figuring out which options to sell, which options to buy every single day at or before market close, even if you're an institutional investor in many cases, right? We've seen increasing adoption in recent years of certain institutional investors, pension funds, endowments, of these strategies that used to be only available from hedge fund and other sophisticated types of investors, because they are so easy to implement, right? They're much lower cost and they're super transparent. In the case of these two products that we're talking about today with ProShares, they both follow NASDAQ indexes that are calculated every second. They're fully transparent. The methodology is out there on our website for investors to read through and really get an understanding. How are those strikes selected every day? What time are they evaluated? How do you roll forward? And the results, I think, speak for themselves, right? What we've seen in a strategy like the Nasdaq-100 Daily Covered Call Index is you get that high beta, right? You get a lot of correlation with the underlying performance of the Nasdaq-100, but at the same time, right, you get to benefit from higher volatility. Right? This is the thing that I think investors still haven't quite grasped about what I think makes the Nasdaq 100 so attractive for some of these strategies where you have to sell options is it is more volatile than the S&P 500. That's not a drawback when your risk-adjusted returns are better, as they are with the Nasdaq 100 versus the S&P. You're getting more performance in exchange for taking a bit more risk, a bit more volatility. But then when you add an options overlay to it, and you're selling options daily or on some other schedule, guess what? You're earning more premium on those sold options because the underlying volatility is a little higher. That can give you more income. If that's the strategy, it could also give you more protection on the downside if you're doing something like a buffered strategy.
Also, using options to shape returns as something in your toolkit is very important in the current environment for two reasons. One, think about income. Folks will traditionally look at the bond market for income, but hey, those tariffs, even if they come in at just 10%, that's a lot more than the 3% we were at, and the big beautiful bill is passed. We could have a little pressure on the long end of the yield curve, and so income from bonds could be at risk from rising interest rates. Getting income from options offers you the opportunity to get income that has nothing to do with the interest rate environment. Yeah. Also on the bond side, you frequently would look or classically look to bonds for risk mitigation to go up when stocks go down. Well, what happened after Liberation Day? We had this fraughtness of de-dollarization and bonds went down with stocks. So having options in your toolkit to shape returns and to deliver income that has nothing to do with the bond market is an important additional way to diversify your portfolio.
With the two products that you had mentioned, are they standalone within a portfolio, or is it to complement existing positions if you have a number of companies within the triple Qs, or could this be standalone?
So the nice part is, if you start with IQQQ, it's really delivering the beta, it's really delivering the Nasdaq 100. So it's very well behaved in your portfolio. And with QB as well, it is the Nasdaq 100 with that buffer structure on top of it. So it's a great way to include a lower volatility way to get exposed to the opportunity of the Nasdaq 100. So it's really well behaved in a core equity portfolio.
Yeah, let someone else, way smarter than me, do all of the work. Mark, I want to talk about Outlook a little bit more. Another area of the Nasdaq 100 that outperformed the index itself was cybersecurity. And that incorporates everything that we've been discussing here, whether it's semis, AIs, the growth of cloud, the growth of attack surfaces and so forth, where it's not a nice to have thing when it comes to cybersecurity, but it's something that companies are, from a regulatory perspective, going to be required to have. And then I also think from a competitive perspective, to have investments in solid cyber plan. And I think we could continue to see that trajectory.
Absolutely, Jill. I mean, cybersecurity has been such a fascinating area to follow, especially over the last few years as AI has sort of changed not just the underlying demand sort of story around cyber, but also the supply side. You talk about playing offense and defense with cybersecurity as it relates to AI, because as you mentioned, there's more attack surfaces than ever. A lot of these AI tools are being adopted by cyber criminals, including a lot of state-sponsored cyber criminals, right, our geopolitical foes abroad. And so that's increasing sort of the underlying offensive capabilities of a lot of these criminals and forcing people to play a lot more defense. How do you play defense when the world gets this much more complicated? You need AI assistance. You need the help of AI-enabled cybersecurity tools to be able to monitor all these different surfaces effectively and coordinate across the different cybersecurity platforms that you are engaging, right, to fend off these threats in a more efficient manner. And so when you look at, the performance year to date, right, cybersecurity has been one of those thematic areas that's leading. We know that because we write about cybersecurity a lot. It's our top thematic area in terms of focused thematic indexes. And you look at a name like Zscaler, right up there in 2Q in terms of performance, up about 60%, right up there with the likes of Broadcom, which of course is a big leader in semis and AI, and a name like Palantir, which has just been crazy on fire. Zscaler and a lot of other cyber names, I think, are really finding their footing this year as people start to understand the implications of that AI wave and how that is changing the nature of cybersecurity.
All right, appreciate both of your insights. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.